I like numbers. Started before I can remember. It just felt good working with numbers. I was always playing around with numbers in one way or another. And it was fun to have a bunch of guys over and have them betting on which marble would reach the drain first. I had a lot of energy as a kid. I was inquisitive, and I was the youngest one always in the class because I'd skipped. I've always been competitive. I like to read more than most kids. I really like to read a lot. My Aunt Edie gave me a copy of the World Almanac, and that was heaven to me. And I can still tell you that almost population was 214,006 in 1930. Some numbers just kind of stick with you. And very early, probably when I was 7 or so, I took this book out of the Benson Library called 1,000 Ways to Make $1,000. And one of the ways in this book was having penny weighing machines. And I sat and calculated how much it would cost to buy the first weighing machine and then how long it would take for the profit for that one to buy another one. And I would sit there and create these compound interest tables to figure out how long it would take me to have a weighing machine for every person in the world. I had everybody in the country weighing themselves 10 times a day, and me just sitting there like John D. Rockefeller weighing machines. The allowance when I was a little boy was a nickel a week, but I liked the idea of having a little more than a nickel a week to work with, and I went into business very early. I started selling Coca-Cola door to door. I sold gum door to door, or sold Saturday Ink Post, Liberty Magazine, Ladies Home Journal, you name it. I think I enjoyed the game almost right from the start.
So during medical school, I put up a website, some ideas on stocks and markets. As I graduated medical school in 1997, Microsoft out of the blue offered me $1 a word to write for the new MSN Money website. Being wordy and being in debt, naturally I said yes. So therefore, during my medicine internship, I wrote for Microsoft and ran my website. There were synergies between 2 of the 3, and I had unknowingly found a back door to Wall Street. None of this was nearly as well planned as it seems in retrospect. There were a number of crises, including a divorce, and at one point I was so despondent over my direction that I even applied to law school. Again and again, I figured as long as I kept asking questions, working so hard to answer questions, I would eventually find my way. As I turned 29, I ran out of reasons why I couldn't or shouldn't and left medicine to start an investment firm. At that point, the decision came very easily. As perhaps should be the case more often than not, I simply weighed the paths before me without considering the path on which I had been. At Scion Capital, my job 24/7 was to ask questions and seek answers. I mostly examined stocks and bonds as long investments. But one day I came across a subprime residential mortgage-backed securitization. And I wondered if I could figure out any of that. Other questions soon followed. Why are home prices diverging up and away from the household income trend line? Answer, if it's not income, it's leverage. What exactly are the incentives of lenders that make mortgages only to sell them on through to Wall Street? Answer, volume at the expense of credit standards. When interest rates bottom, how far could lenders push mortgage terms in order to keep refinancings, home prices, and loan volumes rising? The answer to this question would put a ticking timer on the boom and a date on the crash.
All right. In this episode, we're going to cover two of my favorite investors, Warren Buffett and Michael Burry, two investment legends, two mentors to me personally. We're going to cover their philosophy in investing, their portfolios, and where the two men collide. One stock brings Warren Buffett versus Michael Burry. We'll cover the fundamental details of that particular stock. But before we start, let's go back to 1999, the heydays of the dot-com bubble, because it is eerily similar to what's going on right now in the stock market, the insanity, the mania, the bubble, and the aftermath. Now, Warren Buffett back in the dot-com bubble was mocked and made fun of because he is a value investor. He follows timeless principles of investing, and he seldom diverts from these principles, regardless of what's going on in the stock market, regardless of manias, bubbles, bull markets, bear markets. It doesn't matter. This man sticks to the rules. He has been investing for almost 3/4 of a century, and his approach never gets too old, and he always emerges with the last laugh. Back in 1999, Warren Buffett was actually mocked. He's been called too old. This is back when Warren Buffett was a young man in his 60s, that his approach to investing is outdated, that he doesn't understand the new world of the dot-com, the internet, technology, and therefore the rules that Warren Buffett has been following are not applicable anymore. The world is changing, and this time it is different. Well, guess what Warren Buffett was doing back then? He stayed quiet. He issued warnings once in a while, but for the most part, he's been quiet. His wisdom from that time is something we should all learn from, specifically given the circumstances that we have in the stock market right now. Let's go back to 1999 and hear what Warren Buffett said about the dot-com bubble back then. Take a look.
I sometimes have the feeling, as I look at the stock market today and investment as it is carried out today by so many millions upon millions of people, that to some degree we're engaged in a bit of a pyramid scheme here. That, as long as everybody keeps putting money into the market, it's going to do well, but one of these days somebody may say, whoa, bad idea. Am I being silly about that?
No, if we had a town and there were 100 people and we all had 100 houses, we all agreed to sell our house to each other at the end of each year up 20%. We kept doing that, we'd all feel very prosperous, and the problem would be is when somebody left town, and then we'd have 100 houses for sale, and or one extra house for sale, and we'd find out what the houses were really worth at that point.
Is that and of course when Warren Buffett talks, a lot of people listen. Is that part of what's wrong with the market today?
No. What happened is, over the last 15 years, stocks have gone up terrifically, in fact, since 1982. There have been two very important drivers of that. One is interest rates have generally gone down, and return on equity in businesses have gone up. Those are very good reasons for stocks to go up. After a while, the very act of stocks going up starts drawing in other people who get excited about the fact that their neighbor made a lot of money, or maybe they made a little money over the past years. And the action of the market itself captures the attention of more and more of the participants as opposed to the businesses themselves. And that's when you get into dangerous periods.
Is that where we are?
We're into that to some degree, sure.
How dangerous a period is it?
You never know. I mean, you know.
No, of course you never know. But
you know that valuations are high by historic standards. You know that the level of speculation is high by any historic standard, and you know that doesn't go on forever. But you don't know when it ends.
It's gone on for a very long time, hasn't it?
Yeah, but it's gathered a lot of momentum in the last few years. The last 3 years prior to this one, when the S&P has gone up more than 20% every year, that's almost unprecedented.
A lot of amateurs in the game today?
Yeah, and it's, it attracts people.
Well, sure, as long as they're making money.
Yeah. And those people will get flushed out very easily compared to people who really want to buy a business.
And of course, almost a year later, the dot-com bubble peaked and the crash started. And Warren Buffett came out of his silence and he said, I told you so. You thought that the timeless rules and principles of investing are outdated, that there is a new world that's different this time around. Valuations don't matter anymore. There is a new generation of investors who are changing the game, etc., etc. All of that at the end did not matter. Warren Buffett came out and said, I told you so. Chasing manias and bubbles pays in the short run, but it serves a severe punishment at the end. But following the rules and principles of investing pays dividend in the long run. Now, when the dot-com bubble started, and I put it at around 1996. If we follow the charts from that time all the way to the peak of the dot-com bubble at around March 2000, you'll see that the NASDAQ, the index where the mania was, gained over 700%, while the growth of Berkshire Hathaway was only at around 69%. Obviously, the critics of Buffett at the time said that he's missing out, that his approach to investing is outdated, and by looking at the charts and the results and how lagging Berkshire Hathaway is compared to the NASDAQ proves the fact that the Buffett era is over. But fast forward, since the top of the dot-com bubble of March 2000 all the way to 2007, the NASDAQ was in a bear market. Not for a month, not for two, but for years. It almost lost half of its value. On the other hand, there was no bear market for Berkshire Hathaway. Matter of fact, since the top of the dot-com bubble all the way till the summer of 2007, Berkshire Hathaway scored gains of over 168.5%, while the NASDAQ was down by almost half. And since the dot-com bubble in 1996, almost all the way till today, the NASDAQ is up by over 2,000%, while Berkshire Hathaway is up by almost 1,400%. Now, as we see the current bubble that we have imploding, the question becomes, will Berkshire Hathaway outperform the NASDAQ once again, perhaps for years to come? And the answer to that, maybe not. Why? Because Berkshire Hathaway right now is pretty much a proxy for the NASDAQ, and that is due to the weighting of Apple. Now, digging into the details of that, we have to cover the portfolio of Berkshire Hathaway and the latest moves by the Oracle of Omaha. This is according to the latest 13F filing, which was about a few months ago, so some of this information could actually be outdated, but until we get the next 13F, this is what we have to work with. And according to this report, Berkshire Hathaway opened new stakes in Occidental Petroleum, HP, Paramount, Citibank, Ally Financial, Mickelson, and Celanese. Warren Buffett also added to his stake in Apple, Chevron, Floor & Decor, Activision Blizzard, Liberty Media, General Motors, and Restoration Hardware. On the other hand, Berkshire Hathaway got rid of their entire stake in Wells Fargo, AbbVie, Bristol-Myers, and almost the entire stake that they held in Verizon. Likewise, Berkshire Hathaway reduced its stake in Royalty Pharma, Store Capital, and Kroger. Now, Warren Buffett did not claim that he's a market timer. He never did that, and he doesn't care about market timing. Instead, he cares, as you heard in the beginning of this video, about the numbers. If the numbers make sense, Warren Buffett is in, regardless of where the stock is trading right now, regardless of the technicals, the charts, earnings reports, all of that doesn't matter to Warren Buffett. He's a long-term investor, and as you will hear later in this video, he actually likes it when his stocks go down once he buys, because that allows him to buy at a cheaper price. But regardless of that, for now at least, the timing of these additions and buys were, shall we say, misguided. For example, in his recent additions to Apple, Berkshire Hathaway, Warren Buffett is down almost 5.5%. Likewise, in his latest addition to Chevron, he's actually down about 5 to 6%. He's down almost 8% on his HPQ stake, and so far he's down a stunning over 33% in his recent stake in Paramount. On top of that, Warren Buffett is down over 22% in his recent stake in Celanese, down almost 19.5% in his stake in Markel, and down over 22% in his recent stake in Ally Financial. So what does that say? Even the greatest investor of all time cannot really time the market. He's not a market timer, but he knows the numbers, at least for now, make sense. And so long as the numbers continue to make sense, he will continue to add to his stake in these stocks. Once the numbers stop making sense, you will see in the next update Warren Buffett getting rid of some of these stocks. But if the numbers make sense, he will actually add to them, because he's looking down the road 5-10 years from now. This is the philosophy of Warren Buffett. He's not going to get it right away, but he will get it right in the long run. But these steep losses for now are hammering Berkshire Hathaway's bottom line. In the latest report, Berkshire Hathaway's revenues were up by over 10% year over year. Their expenses were up by almost 6.6% year over year, but they reported a stunning loss of over $43 billion. What was the reason behind that? The answer is, as you can see, the losses in investment. All of these numbers, the portfolio is down. They reported a loss of almost $67 billion. Almost half of that came from the recent declines in Apple stock, and hence the problem with Berkshire Hathaway that they have never faced before in their history. Warren Buffett, for the first time, is facing a concentration problem in Berkshire Hathaway, where Berkshire pretty much became a proxy for Apple. Now, how would Warren Buffett deal with that? Is he going to reduce his stake in Apple? I don't see that as foreseeable because, as you'll hear later on in this video, he really likes the name and believes in it. But will he go on a spending spree to reduce his overall concentration in the portfolio on Apple? That remains to be seen. But for now, Berkshire has a major problem. If Apple goes down, so will Berkshire. This is a problem that we have not seen before in this company. They never had such overweight and concentration on a single stock before, and hence the Apple dilemma. For now, looking at the portfolio of Berkshire Hathaway, these are the stocks with weighting of over half a percentage point on the entire portfolio of Berkshire Hathaway. The names are Citibank, US Bank Corp, Moody's, the Bank of New York Mellon, Bank of America, American Express, Visa, and then in technology they have Apple, Amazon, HP, VeriSign, Activision Blizzard. In media, Charter Communication, SiriusXM, Paramount, and in consumer staples, Kroger, Kraft Heinz, Coca-Cola, and Energy, Occidental, and Chevron. In healthcare, the only name left in the portfolio is DaVita, and the only automobile company they own right now with such huge concentration is General Motors. But perhaps the most notable trend in Berkshire Hathaway's portfolio is the company's shift toward energy by adding a huge stake in Chevron, not to mention Occidental Petroleum, which, for now, the assumption is Berkshire Hathaway will end up owning the entire company at some point. So in summary, when we look at the portfolio of Berkshire Hathaway recently, Warren Buffett continues on the same path of value investing. When the numbers make sense, he's going to buy regardless whether the stock is going to go up or down in the short run, regardless of what the technicals look like for now. When the numbers stop making sense and certain stocks run too high or cease to perform as expected after giving ample opportunity, Warren Buffett and Berkshire Hathaway get rid of these stocks. And the beauty of these moves by Berkshire is that even though Warren Buffett might be down 20-30% in some of his recent positions, so far, we get to look at these names and we do our own diligence. And if the numbers make sense for us, we get to buy these stocks at a cheaper price, a better deal than Warren Buffett. Now, the other investor that I'm talking about in this video is none other than the big short, Michael Burry. Michael Burry is famous for calling the dot-com bubble and, most notably, the housing bubble in 2007 to 2009. Michael Burry warned back then, but nobody listened. And then when he was proven right, all eyes turned on Michael Burry and he became a household name, at least among the investment community. So when Burry talks, we have to listen. Most importantly, when he warns, we certainly have to listen. But unfortunately, we have this era of delusion, just like we've seen back in the dot-com bubble and the housing bubble, where market participants assume that this time is different. For whatever reason, fill in the blank. Well, Michael Burry comes out and says the ghosts of the 2008 financial crisis are still alive. It's gonna happen again. And the reason is, according to Burry, this inflation problem will last for years. We are finally seeing the blowback of the reckless policy by the Federal Reserve for almost over a decade now. Some would argue more than at least 2 decades. And we're seeing the ramifications right now in the form of inflation. And it will take a long time for this inflation to go away. And it's not going to go away without aggressive action by the Fed, which will result in a market crash and an economic recession. Now, when we look at the portfolio of Michael Burry, he always has interesting moves in his long portfolio. Some would say that he should stick to shorting stocks because he's not really that good in buying them. But regardless of that, the portfolio of Michael Burry, according to the latest 13F filing, contains a stake in Stellantis, Global Payments, and the disaster of Warner Brothers Discovery, Nexstar Media Group, Alphabet, Meta, Bristol Myers, Oventive, Booking Holdings, and Sportsman Warehouse. Now, Michael Burry is not a market timer either, as you can see from the results, according to the latest 13F filing. On his stake in Booking Holdings, he's down by over 15%. On the disaster of Warner Brothers Discovery, he's down by over 40%. On his stake in Alphabet, he's down so far by more than 15.5%. In his stake in Meta, he's down by over 23%, and the list goes on and on and on. So these investors, as great as they may be, they're not really good market timers. They make mistakes too. But in the long run, when these investors stick to their principles and the rules, they emerge victorious. And in this case, Michael Burry happens to be an admirer of Warren Buffett's teachings. And here's Michael Burry's thoughts about Warren Buffett according to a recent interview. He says that Warren Buffett is unique and being different is the key to investing success. If you're going to be a great investor, you have to fit the style to who you are. Burry told Lewis, this is the interviewer, he noted that Buffett did not copy his mentor. Benjamin Graham, but instead crafted his own investment approach and philosophy. This is really important. We can admire Buffett and Burry and all of these investors, but do we have to copy them exactly? The answer is no. But we can learn from them, their philosophies and approach to investing, but we can craft our own. Continuing, Burry also said that he lacks Buffett's charm and social skills, and knew he would never be as popular as the Oracle of Omaha. The Sion Asset Management chief mentioned Buffett several times in previous tweets. Burry's bookshelf underscores his deep interest in Buffett's teachings, even if he does not follow them to the letter. It features security analysis, co-authored by Graham, and known as the Bible of Value Investing. He also has 3 collections of Buffett's letters to investors in his partnership and Berkshire shareholders. The Sion boss also owns the Warren Buffett portfolio, Mastering the Power of the Focus Investment Strategy. So it is clear that Michael Burry is an admirer and a follower of Warren Buffett's teachings. And this makes the collision between the two investors really interesting. And this collision happens to be around the stock of Apple. Warren Buffett is long, he continues to add, he likes the stock. On the other hand, Michael Burry is actually short via put options. So what do the two investors see in the stock of Apple, the largest stock in the world? Well, let's take a look at the numbers from the latest earnings report and see if we have any signs of trouble or signs that the business is doing great. According to the latest report, net sales for Apple went higher by 1.87% year over year, while the cost of sales went higher by 1.93% year over year, and operating expenses went higher by 15% year over year. So this is a bad recipe because you have a company where the growth rate in expenses and costs is actually rising higher than the growth rate in revenues. This is a problem, and therefore we see the net income year over year for Apple actually being down 10.58%. On the other hand, the operating margin, meaning how much does the company keep in profits from each dollar it generates in revenue. We're talking, of course, about operational profits, not factoring in taxes or any other factors. Because the beauty of the operational margin is it tells us whether the business is lean or not, how much it is keeping from each dollar it generates in revenue and profits from an operational standpoint. And in this case, the operational margin for Apple is at around 27.81%, which is actually really good for a company this size. We will look at the different segments. For Apple, the growth in sales in the Americas was up by 4.46% year over year. Likewise, the growth in sales in Europe was up year over year by about 1.81%. On the other hand, the growth rate in China was negative by about 1%. Likewise, it was negative in Japan by about 15.75%. On the other hand, it was actually positive by 14% in the rest of the Asia Pacific. So few signs of concern here from China and Japan, but not in other territories. We'll look at the different products of Apple. The growth in sales year over year for iPhone was up by 2.76%, while the growth sales in Macs, that's what they call them, down about 10.36% year over year. The growth in sales for iPads was down by 2%. Year over year. Likewise, the growth in sales in wearables was actually down by about 7.87%, while the growth in services was actually positive by about 12.11%. So we have few signs of concern here. The company is obviously slowing down. We're seeing a slowdown in Mac sales, iPads, wearables, but not a significant slowdown in iPhone, the crown jewel of the company, not a significant slowdown in the highest growth factor of the company, services, and certainly the drop in Chinese sales was not as bad as many have anticipated. But we have to look for trends and whether there is a divergence in these trends. Recent divergence indicating that the company is doing better than usual or worse than usual. Are we seeing a slowdown in certain trends or acceleration in certain trends? Well, to me, the most important trend is the growth in revenue from iPhone sales. And we'll go back all the way to 2019. As you can see, the trend peaked at around 2021 when iPhone sales grew by over 50% year over year. But when we fast forward to this year, the rate of growth in iPhone sales slowed down to 28%. Now, some would argue that this is a distortion, that 28% is not really that bad because we're pinning it against 50% growth rate from last year. But that growth rate happened because of the pandemic, the lockdowns, and the slowdowns of sales in iPhone in 2020. So the base impacts alone exaggerated the growth rate in the sales of iPhone in 2021. But now the company is going back to the average trend pre-pandemic. Another important segment for Apple is the services revenue. Now, I'm a critic of Apple's service revenue because I call it the shakedown money. It's sort of like the mafia business model. I actually call it the iMob because they tend to intimidate and harass app developers to give away 30% of their revenues to Apple. 30% of their sales being cut to Apple just because the app is on Apple's platform. Some would argue that the services revenue is a monopoly, and hence the regulatory risk that could come out of Asia, Europe, or even this country, and that could damage the services revenue. But for now, we don't have any clear regulatory risk when it comes to the services revenue for Apple. But is it slowing down in its own already? Well, let's see. The services revenue for Apple peaked in 2021 at around 33% growth rate year over year, and it now slowed down this year all the way to 12% year over year. Now, once again, we could have distortions due to the pandemic and the pent-up demand in 2021, and now the trend is back to normal. The growth rate is not problematic for services, at least right now. From my perspective. Another important factor for Apple is the operating margin. The company is profitable, and so long as it continues to be profitable, the stock will do just fine, outperform its peers. Well, the operating margin is at around 28% in 2022. It was higher in 2021 at around 30%, but in my opinion, for a company its size, an operational margin of around 28% is actually pretty decent, so there is no problem here. What about China sales? Could we see a problem with the sales in China? Well, it could indeed be a problem for the company because Apple sales in China experienced negative growth by about 1% this year. And this has been a problem since 2019, when the company's China's revenue experienced a decline of about 4% year over year. But then we saw a recovery. In 2020, the growth rate in China sales went higher by 19% and a stunning 58% year over year in 2021. And everybody assumed that the China demand is back on the table for Apple. All of these problems that everybody talked about, that the Chinese consumer is drifting away from Apple for whatever reason, these concerns are overblown. But now, here we are, once again, we have a slowdown of about 1% year over year in Apple sales in China. Of course, Apple bulls will defend that as, well, China had shutdowns and lockdowns in the second quarter of this year, and therefore, of course, Apple sales got hit in China. But once we see normalization of the lockdowns being lifted, we will see a rebound in Apple sales in China, and therefore the next quarter it will be of critical importance. And perhaps the most important number that everybody's going to look at is sales in China. If that number experiences negative growth once again, despite the easing of the lockdown restrictions in China, that would be a major problem for the stock, and it could produce a shock. And that brings us to, is this the theory behind Michael Burry's short in Apple? Because he is mystery man, he doesn't explain why he's shorting Apple. So instead, we have to speculate on why Michael Burry's shorting Apple. Now, I am certain that the slowdown in Apple sales in China is a major reason behind shorting the stock, but perhaps we have an overall general slowdown in the global economy, and perhaps we will see recession in the United States, in Europe, in Asia, and this will cause the demand for iPhones to slow down. This is not just the sentiment of Michael Burry, of course assuming that this is one of his theories behind shorting the stock. It also happens to be the consensus among many analysts, including from Bernstein, who said that Apple's near-term future looks murky as consumer spending slows. So when we see consumers not enjoying stimmies and free cash, that consumer demand slows down. People are not buying iMacs, iPads, watches, and soon enough maybe iPhones anymore, and that could hurt the company tremendously. In this program, we talk a lot about the impact of inflation on consumer budgets, that the consumer has to cut down on non-necessities, such as buying iPhones and otherwise, because they have to spend more at the gas pump, the grocery store, on rents, on utilities, things that the consumer deems as necessities, unlike iPhones. You don't have to upgrade your iPhone when you're facing inflation. You might want to delay that until your financials get better, and that could hurt Apple. And this is really the main bear theory against Apple, and it is being proven. For example, Apple already announced that they're cutting down spending and hiring next year because they see a potential downturn in the economy. And another bear theory is Apple holds the majority of the weighting in stock ETFs. So if there is a crash in the stock market, the ATM of getting cash out of the stock market becomes, well, the largest stock in the world, the stock of Apple. And this could be another theory behind Michael Burry shorting the stock. Now, why does Warren Buffett like the stock and continues to add to his stake over and over and over again, even though the weighting is becoming a problem for Berkshire Hathaway? Well, perhaps here's one reason. Take a look.
I like to buy them cheaper. I mean, it's very difficult. I started buying when the stock was maybe 100. I was buying it kind of as fast as I could. And then I ended up buying some as high, a whole lot higher. I won't name the exact price, but a whole lot higher. I'd rather have it go down. For one thing, if it goes down, Apple's going to buy a lot of stock back. They're already buying stock back. And if it goes down 10%, it means they get to buy 10% more shares, and my interest will go up 10% more for spending that money and buying shares. So I am benefited by going down. If I were to talk my book, I would talk it down.
So here it is. One theory is Apple is flush with cash, and they have a share buyback program worth over $100 billion. This is almost the budget of a decent-sized country. Apple going to use all of that cash in buying back stock. Now, I am a critic of stock buybacks. I think they should be banned. I'm a fan of dividends, but your beloved politicians have not fixed the double taxation problem when it comes to dividends. And therefore, companies like share buybacks. They contribute nothing in tangible value. I would rather the company invest that money in R&D, but it is what it is. There is an active Apple put. If the stock goes down by too much, the company has an insane amount of cash to buy the stock and stop the bleeding. And this is one of the theories why Warren Buffett continues to like the stock and continues to add to his stake. Here's another reason. Take a look.
If you look at that little piece of whatever it is, that is some of the most valuable real estate in the world. I mean, that is, Fifth Avenue will never come close to that. I mean, it is, you've got hundreds and hundreds of millions of people with loads of buying power and able to do business or learn information or whatever it may be, and it's part of their habit of living. I mean, they spend hours a day, and it does all kinds of things for them. So that real estate is worth a fortune, and it's nice to have it added to as they sell new phones, and of course a lot of them are replacement phones. But they're adding to hundreds and hundreds of millions of consumers that are never going to get to Fifth Avenue, or they're never, and you are an indispensable part of their lives. I mean, it's an extraordinary product.
So you don't even look at it like a tech analyst would, or like a tech company for that matter.
So Warren Buffett, as you can hear from the interview, he doesn't view Apple as a technology stock, and he doesn't really understand fully how iPhone works, but he doesn't need to. He doesn't need to know the nitty-gritty details of what an iPhone does. All what he needs to know is, this is the new Fifth Avenue. This is the 21st century Fifth Avenue. Human-to-human interaction, marketing, advertising, shopping, all happens within the palm of our hands. It is not just the opportunity of Apple or any phone manufacturer in this case selling the hardware, but it's also the endless opportunity of monetization from what the platform and the hardware actually offers. Endless commercial opportunities. Here's yet another reason why Warren Buffett continues to like the stock.
And, they talked about the iPhone 10 costing $1,000, and that a lot of money. I have a plane that costs me a lot, maybe $1 million a year or something of the sort. If I used the iPhone, I use an iPad a lot. If I use the iPhone like all my friends do, I would rather give up the plane, which is $1 million or $1.5 million a year, for something that costs $1,000. I mean, the iPhone is enormously underpriced. Now it's got competition, so you can't push the price. But in terms of its utility to people and what they get for $1,000 someplace else.
Once again, the iPhone, for those who use iPhone, is a necessity. It is a utility, and people cannot live without this essential utility called an iPhone. Matter of fact, there are ridiculous polls, for example, surveys, where they ask people, would you rather lose a finger or not having access to smartphone for over, let's say, a year? A lot of people say I would rather lose a finger than not being able to use my iPhone. People are addicted. It's their life. It's how they communicate with their friends, how they conduct commerce, how they conduct business these days. And that brings a lot of opportunities. And this is the lesson from Warren Buffett's style of investing. You don't need to know the nitty-gritty details of the company or the stock that you're investing in. All what you need to do is to understand what this company, what this business is going to look like a few years from now, and you buy a stake in that company. Now, does the timing matter in this style of investing, the Warren Buffett style of investing? Here he is again, Warren Buffett.
And so Apple is kind of like a farm.
Well, it's a long-term investment, and if you own the best auto dealership in town, the best brand, and had somebody good running it, you wouldn't drop by every day and say, how many people have come in today, or I think interest rates are going up a little. Maybe it'll slow down our sales or anything. No, You buy it knowing there's 365 days a year, and you're going to own it for 20 years, so that's 7,300 days. And things are going to be different from day to day and year to year. You shouldn't buy it if the day-to-day stuff is important.
And there it is. It's like a farm. You don't have to go every single day and look at the stock and where the chart is trading. Because when you buy a piece of a farm or a business, all what you care is the results at the end of the day. And so long as they continue to move in the right direction, growing sales and profits year over year, you don't really care where the stock is trading. The stock can go up, can go down, but in the long run, the investment will be profitable. This is the Warren Buffett style of investing. So let's conclude here. Two legendary investors that I've always admired. I remember back when I was a teenager, I would read Warren Buffett books, and I became very fascinated with investing. And the moment I turned 18 years old, the first thing I did is I went to the broker and I opened a stock market investing account. And of course, I used everything I learned, I read about Warren Buffett to guide my investment strategy. At that time, of course, Michael Burry was not on the radar, but it came later on, and I became an admirer of his style of investing too. The bottom line is, as an investor, you look at these two great investors, legendary, but is their style of investing really fits your needs? What you have to do? The answer is, it might not. For example, in Warren Buffett case, you might not have enough time to be such a long-term investor. Maybe this style doesn't work for you. Buying value stocks, getting dividends, maybe waiting for years until you see tangible growth in your investment. Maybe this is not a fitting style for the majority of retail investors. A, we don't have the time. B, we don't have the amount of capital that makes this strategy worth it. Likewise, when it comes to the Burry style of investing, not a lot of people can short stocks or want to short stocks or even willing to bet against excessive speculation in the economy because it comes with a lot of risk. But the bottom line here, folks, is you take the principles from these two investors, and it boils down to this. For Warren Buffett, it's all about the numbers. If the numbers make sense, Warren Buffett is in. If the numbers don't make sense, Warren Buffett is out. And therefore, in this channel, we always follow the numbers. In my own investment style, I always follow the numbers. If the numbers make sense, I'm in. The numbers don't make sense, I'm out. I don't care what the stock does day to day or month to month. That doesn't matter. I'm not seduced by these kind of moves. If the numbers make sense, good earnings, decent valuations, you can buy and sleep like a baby, knowing that the investment will pay because it is based on the principles and the fundamentals. And you don't have to wait decades or years for such an investment to work out. All what we have to do is watch the numbers. They make sense, we're in. They don't make sense, we're out. When it comes to Michael Burry's style of investing, as you heard in the intro of this video, it's all about asking questions. As an investor, you ask questions. Why is this stock ran 70% to the upside in a short amount of time? What was the reason behind that? Was it a fundamental reason? Was it an acquisition? Was it because the company expanded somehow? Or was it due to speculation and gambling and mania? And if that is the case, what is the reason behind the mania? The answer could be because of the Fed's easy money policy, quantitative easing on steroids, the stimulus money all over the place, whatever answer that fits that question. Now you ask the follow-up. Well, what happens when this catalyst that enabled this insanity to happen to begin with goes out of the window and it's no longer available? In this case, what enabled the mania is the Fed's easy money policy. Well, what happens when that changes? Let's say because inflation moved higher and the Fed has to shift and move to quantitative tightening instead. Well, that puts an end to the mania and the beginning of the crash and the correction. The reversion to the mean. This is the opportunity where you short. And in my years in investing, I combined these two great investment strategies, Warren Buffett, looking at the numbers, whether they make sense or not, and Michael Burry's style of asking questions. And this combination, using the numbers and asking questions, is a powerful tool for any investor to follow and use to guide their investment strategy. In conclusion, follow the numbers and ask questions, and this alone will make you a Teflon investor. Bull markets, bear markets, that doesn't matter. You have a set of principles that guide you throughout any kind of market you can face. You will emerge victorious. And folks, until the next episode when we cover other legendary investors and their investment strategies, this is all I got for you for now. A reminder for regular viewers, the technical analysis of the stock market will be out later this evening. For now, I hope you enjoyed this video. If you did, kindly press the like button, subscribe, leave a comment, and share the video with others. With that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again soon.
People want an authority to tell them how to value things, but they choose this authority not based on facts or results. They choose it because it seems authoritative and familiar. And I'm not and never have been familiar.